So let's talk about Benjamin Graham's classic, The Intelligent Investor. Now, this book isn't some get rich quick scheme. Far from it. It's really about how not to go broke. Its whole purpose is to help you build an intellectual framework for investing, one that arms you against the kind of catastrophic mistakes that can completely wipe you out. So let's dive into this masterclass on how to be your own best financial ally. Right out of the gate, Graham hits us with a truth that cuts right to the bone. He argues that the biggest risks we face, they don't come from a crazy market or a bad stock pick. Nope, they come from right inside our own heads. To put it simply, when it comes to our money, we are often our own worst enemy. And when we let our emotions grab the steering wheel, well, the results can be absolutely devastating. You see this number? That's what happened to a $10,000 investment in so-called expert tech stock picks from the peak of the dot-com bubble, a 94% loss. That's what happens when market hype just totally drowns out rational thinking. Back in the late 90s, this kind of emotional decision-making became a full-blown epidemic. Graham would have called it a speculation nation. I mean, you had celebrities like Barbra Streisand admitting she'd sell a stock just because its price turned red on her screen. Come on, when your entire financial strategy is based on color coding, you're not investing, you're just gambling. And this brings us to Graham's first and maybe his most fundamental principle. You must understand the difference between being an investor and being a speculator. Believe me, they are two totally different things. So here it is, Graham's timeless definition. A real investment operation needs three things. 1, you've done a thorough analysis. 2, it promises that your initial money, your principal, will be safe. And 3, you'll get an adequate, not necessarily spectacular, but adequate return. Anything that doesn't check all three of those boxes, that's speculation. Full stop. You know, this whole distinction really just boils down to two completely different mindsets. The investor, they're focused on the actual value of the business itself, its profits, its assets, its future. The speculator, on the other hand, only cares about one thing, the stock's price movement. They're not really buying a piece of a business, they're just betting on which way the market's mood is going to swing. And this analogy just perfectly illustrates the danger. I mean, think about it. You might get away with driving 130 miles per hour once or twice. You might even come back and brag that it worked. But is that a sustainable strategy? No way. Sooner or later, that level of risk-taking ends in total disaster. And it's the exact same thing for speculation when it's pretending to be investing. So how does an intelligent investor navigate a market that's so often driven by this kind of speculative madness? Well, Graham gives us this incredibly powerful mental tool, an allegory he calls Mr. Market. Okay, picture this. You co-own a business with this guy, Mr. Market. Every single day, without fail, he shows up and quotes you a price. He's happy to either buy you out or sell you his stake. Super accommodating. The only problem, he is, to put it mildly, completely emotionally unstable. Some days, he's just euphoric. He sees nothing but blue skies ahead, boundless profits. During the dot-com boom, he looked at a company like Inktomi and offered to pay a price equal to 250 years of its sales. It's a ridiculously generous offer, and it's driven by pure mania. But then, other days, he's in this deep, dark depression. He's convinced the world is ending, the business is doomed, everything's a disaster. And in his panic, he'll practically beg you to take his shares for pennies on the dollar, totally ignoring the actual stable value of the business. His price isn't based on reality, it's based on pure terror. And here's the crucial point of the whole story. Mr. Market is there to serve you, not to guide you. You are totally free to just ignore his daily offers. Your job is to resist his emotional craziness and actually use his wild mood swings as an opportunity to buy from him when he's pessimistic and maybe sell to him when he's euphoric. This leads us right into Graham's third and, honestly, his most important concept. If Mr. Market is irrational and the future is totally unknowable, how do you protect yourself? Simple. You use a margin of safety. The margin of safety is truly the bedrock of value investing. You can think of it like a financial shock absorber. It's simply the gap between what a business is actually worth and the price you pay for a piece of it. The wider that gap is, the more room you have for things to go wrong. So here's how it works in practice. First, you do your homework and figure out what you believe a business is truly worth. Step 2, you wait. You wait until Mr. Market, in one of his depressive fits, offers to sell you that business for much, much less than your calculated value. That discount, that is your margin of safety. It protects you if your valuation was a little bit off, and it shields you from all that random market chaos. And this is the real power of the margin of safety. It frees you from needing a crystal ball. You don't have to perfectly predict next quarter's earnings or which way the economy is going to go. If you consistently make a habit of buying $1's worth of assets for, say, 60 cents, you've built yourself a powerful cushion against an uncertain future. You know, all of these principles, distinguishing investment from speculation, using Mr. Market, demanding a margin of safety, they all build to Graham's final, crucial point. It's not enough to just have the right intellectual tools. Ultimately, successful investing is a matter of temperament. Graham saw this over and over again during his lifetime on Wall Street. He saw people with huge IQs and massive financial knowledge fail, all because they lacked emotional control. And at the same time, he saw ordinary people succeed, simply because they had the patience and the discipline to stick with sound principles. For those people with the right temperament, market chaos isn't a threat at all. It's the single greatest source of opportunity. The more irrational and silly Mr. Market becomes, the bigger the bargains he's going to offer you. Folly isn't something you should fear. It's something you can profit from. So, that's Graham's timeless framework. Know the difference between investing and gambling. Use the market's irrationality to your advantage. And above all else, always, always, insist on a margin of safety. The real goal is to profit from all that folly out there without ever participating in it yourself. And so the final question isn't about markets or stocks. It's about you. Do you have the temperament to actually do it?